It is my understanding at the time that this is filled that if a child has the ownership of the 529 in their name, or if the parent has the ownership of the 529 in their name, when you are filling out all of those college age forms, that has to be disclosed. It can reduce the amount of college aid that you have. Having the ownership outside of the immediate household can be to your advantage. I'm not going to spend a lot of time here on structuring college age. That is really not my specialty. There are other people that they thrive in that area. Again, a couple of years before you're going to see a child going into college, get with professionals and structure the assets to enable you to get the greatest amount of college age possible by using some of these tools. Let's talk a little bit about non-qualified accounts. Well, what does even non-qualified mean? It's usually a term that your advisors are going to be aware with, but not so for the general public. Now, some non-qualified examples, think about your checking account or a CD that is in your name. How about a money market account? These are accounts that do not have anything to do in a title with a retirement account. So those are some non-qualified examples. One of the things about the non-qualified examples that you should take advantage of for estate planning purposes is, if you ever heard of POD, pay on death? Well, if you don't want these assets to be tied up into the estate, this is totally revocable. It's a simple little piece of paper. You could ask your institution for POD or pay on death. And let me give you an example of how that might work. My husband and I own an account jointly. So as long as one or both of us are there, we have the money. Both of us happen to pass away at essentially the same time. Maybe it was one of those terrible accidents you see in a headline somewhere, you know, what none of us wants to be. But anyway, we're both gone and we have POD on the account, and we list our children with percentages of how much they're to receive. They would need to go to the institution and they would have to provide death certificates and identification. And then those proceeds would be paid to them in the percentages that we had indicated. It doesn't go through the estate. It's not subject to probate. It's not subject to creditor claims. It's very, very quick. So this can be an excellent solution on those type of non-qualified assets that you don't want to go through probate. Now, along with that, if any of my children showed up at the bank and said, hey, I want to know how much money mom and dad have in that account, you know, I'm a beneficiary, they're not going to tell them anything unless their name is on the account as an owner. When they show up with the death certificate and identification, then it's their business. But up until that point, it's not. So you'll be able to maintain that privacy you'd like to maintain. So what are some other non-qualified examples that we have? Well, those are some that you're going to be pretty familiar with. How many of you have stocks? How many of you have mutual funds? Well, see, those are non-qualified examples. Could be ETFs. Those type of things that, again, they do not have any type of retirement titling in the title when you look on your statements. Can we do something similar to those assets? And the answer is yes. It's a little different process. You can fill out what's called transfer on death, or TOD. And on a transfer on death, if I had, let's pretend that my husband and I, again, we owned mutual funds. We'll pick mutual funds. The title's in both of our names, and as long as we're both alive, we both have equal access to it. One passes away, the other one does. We both have passed away. And as long as I have that TOD, transfer on death, on the account, then my children would produce death certificates and they would produce identification. Different paperwork is filled out. Takes just a couple of days longer than POD because these are not cash assets. And there's a good reason why it takes a little longer. Let's pretend that they turn in all the paperwork on Monday. And on Monday, it's all in good order. Everything is there that we need. So overnight Monday, we put it into the computer and we're changing things. Well, then on Tuesday, we process the paperwork. And so it goes into the system under the new account owner's name. And at that same time on Tuesday, we are getting a new value or a new stepped up cost basis on the accounts, which under current law, you could get a step up and the beneficiaries would not have to pay taxes on any of those capital gains. So there's a real benefit there to making sure that we get that accurate and current cost basis on it. On the third day, the account is in the beneficiary's name. It is theirs. All of the assets have remained intact. They have not been sold because of that cost basis issue. Now they can at that point liquidate the account entirely, go do anything they want with the money. They could leave the positions as is, or they could liquidate some of them and put them into investments that were more aligned with what their risk tolerances or preferences were. So transfer on death can be an option for some of our non-qualified assets. And all it is a piece of paper. It's revocable at any time. So you've got a ton of flexibility there on that particular non-qualified asset. What's another non-qualified example? Well, how many of you have heard of annuities? Well, annuities, they can be very different. Again, if you purchase an annuity, you're generally going to wait until after 59 and a half, because on an annuity, if you cash it out at any time on a non-qualified contract, the earnings or growth on the annuity is given to you first, and you are taxed on it, and the amount that you deposited or your cost basis is returned to you last tax-free. Now, with an annuity, those are sold by insurance companies, so you will be filling out beneficiaries, and I suggest a primary beneficiary and a contingent beneficiary on those. Now, that is an option that you have. There are many, many different types of annuities. We have fixed annuities. We have equity indexed annuities. We have variable annuities. So you've got a lot of choices, and some of that depends on what your risk tolerance might be on what you want to do with those. Well, I've given you a lot of information quick, and you probably had never heard of non-qualified before. So it's like, well, how do I know for sure if it's a non-qualified example? A very easy way to tell, do you get a tax form at the end of the year? And does the tax form indicate amount of taxable interest or dividend? That's a red flag that is a non-qualified example. So that's very easy. Now, on a non-qualified annuity, you might get an annual statement, but unless you have taken money out of the account, you are not going to see any type of a tax document until you do some withdrawals from that particular asset. There's one other asset that is really considered to be a non-qualified example, and that is life insurance. Life insurance can have cash values, but it also has usually a substantial death benefit. Now, there are some individuals who use life insurance not just to provide for survivors, but they're using it as an alternative investment. They may be overfunding the policy in order to get higher amounts of cash values. There are many types of life insurance. There is whole life. There is universal life. There is equity indexed life. There are mutual fund companies. They're mutual insurers that also have participation in the profits of the company, a little different in there. But there are ways that you can build up cash within specific policies. Now, most of these are market-based, or they'll have variable accounts. So again, you want to talk to a qualified professional. You do not want to talk to your nephew who's been selling insurance for 2 weeks. This is not the place to help. Hand the kid a check to help him out, but don't let him be your insurance advisor. That's my own personal thing there. Now, the other thing that goes along with that is you need to have an insurable need for the coverage. So there are some conversations that have to take place. And there are some other classes where I discuss with you about how to structure the ownership and the beneficiaries so all of the life insurance proceeds remain tax-free to you. Now, there are some individuals, as an alternative type of an investment, it's called a personal pension plan. Maybe you've heard that, maybe you haven't. It's usually called a tax-free personal pension plan. And the reason for that is we're using life insurance as the base, and then they were building it or structuring that so that it will provide a tax-free income to you later, usually for retirement, to supplement whatever your income is. You do not have to be associated with any employer. You can be a W-2, you can be self-employed. All of these things could work with this type of a particular program. Now, on your screen, I'm going to ask my staff to go ahead and put up a sample illustration, and understand that this is just an example. You're probably going to notice I don't say if this is a male or a female. I'm not telling you how old they are, because all I really want you to concentrate is to understand the very basics, and I want to remove all the clutter. Now, these particular programs, you could put a few $1,000s a year in, up to much, much more. It depends upon what you're trying to accomplish. And then it also depends on what your circumstances are. Now, in the example that you see in front of you, you're going to see in the left-hand column where we've got a net annual outlay, and you're going to see the sum of $95,000. Hypothetically, this person sold real estate, an apartment complex, whatever, and they wanted to set up a personal pension plan that they could use going into retirement. And they also wanted to leave an inheritance. So there was a combination need, and this happened to be the solution for them. You'll notice that they put $95,000 in for several years consistently. Whether they did this monthly or annually, doesn't matter. That's what they put into it. And you're going to notice in the first year, they put in $95,000. The surrender value is very small because they do not want you to put this in and turn around and take it out. And then there's a death benefit of $1.7 million. Now, what if this person put in $95,000 and they died in the first year of the policy and they never realized the income stream that they had been planning on? Then their heirs, or the beneficiaries that they had named, would receive the death benefits of a little over $1.7 million. So that definitely would have leveraged the $95,000 that was in the estate before death occurred. But let's say this person lives on. And as they live on, you'll see over on the far left-hand column where we start to see in parentheses minus $40,616. That is the point that they started pulling $40,000 a year out of the policy as an income stream going into retirement that was tax-free because of the way that we have structured this particular component. I want you to look down at where there's a break, and you'll see that they've pulled out the $40,616 now for 3 years. And over on the far right-hand side, there is now a little over a $2 million death benefit. Every year going out into the future, when they take cash out, you'll see that it changes what the surrender value is. So if a person said, you know what, I just want the lump sum, I don't want to take it out in an annual amount anymore, then we've got a surrender value they could take, or they could continue taking the income stream and then have the death benefit that changes a little bit. Now, looking at this particular thing on the net outlay, you're going to see that this $40,616 came out for quite a few years, and then they stopped it. They just didn't need it anymore, but they had another ulterior motive on it. You're going to notice at the end of the time frame, they had at that point, the death benefit was down to $338,000. They had enjoyed this income for many, many years tax-free. And at this point, they still wanted to leave some type of a legacy tax-free to whoever they'd named as beneficiaries. So this is what is frequently known as a tax-free personal pension plan. Reach out, talk to your professionals if this is something that you want to explore. And it's an option that is available. Now, one of the other things we need to spend a minute on, because I keep using the word beneficiaries. Well, when you have a beneficiaries, it's really important on all of your assets that you can possibly put a beneficiary on to include those. And why? If we have a beneficiary on our assets, then they will not go into the estate, which can be the most expensive and least efficient way to pass out assets. And by having those beneficiaries, we can avoid probate. We can avoid attorney fees and creditor claims and court costs and inheritance taxes and on and on and on by structuring our assets to our advantage. So let's spend a minute and let's talk about on our beneficiaries, how many of you know the term per capita or per stirpes? Because this comes into play with your beneficiaries. Behind each one of your beneficiaries' names, in my perfect world, I'm going to have you include the words per stirpes or per capita. I'm going to talk about per capita first. All right, let's pretend we have 4 beneficiaries and I have named them to all get an equal percentage to keep this simple. Maybe they're my children and I have put the word per capita behind each name. What if one of my children passes away before I do and I have not updated the beneficiaries? Well, per capita means that that beneficiary has to be living in order to receive the proceeds. So child 1 gets their share, child 2 gets their share, child 3 gets their share. But since child 4 has passed away, then their share is divided equally between the remaining living beneficiaries. So that is per capita. And if that is your preference on how your assets are passed out, you want to start using that term. Now let's go back and we're going to now talk about per stirpes. I have the same 4 children. And let's say on these 4 children, I have put the terms per stirpes behind a couple of my children. I have the same scenario. This particular child has passed away. And when they passed away and I had per stirpes behind their name, each one of the 3 living beneficiaries still get the same percentage that they had before. But you see this child who had passed away that was under per stirpes? Well, they happen to have 2 children. Those 2 children would inherit that deceased child's percentage of the assets. And that way I would pass it to my grandchildren. So for many of you, you don't always read those pages and pages of things, that we sign because they just go on forever. These accounts generally have default language in them on exactly how they're going to handle those scenarios if you have not updated beneficiaries. It may or may not be what your preference would be. So put the words per capita or per stirpes behind the name, and we can avoid all of that. Now I'm going to go back to the 4 beneficiaries. I do not have to name every one of them per capita or every one of them per stirpes. I could do per capita, per capita, per stirpes, per capita. I can pick and choose how I want that to work. I don't need a court process or anything else to make that happen as long as I fill it out on the papers correctly. Now, I'm going to spend a minute here about, how you arrange and fund your accounts for retirement or for your other needs really matter? I'm going to say absolutely yes. You are going to pay taxes now or later. But one of the things that changes is your tax bracket, the tax code, and what the capital gains rates can be and how things are treated. So one of the things that I really stress with the clients that I work with is we're going to do what I call working the brackets. We're going to look at where we are in the brackets now. What do we expect to happen, within the next couple of years and even beyond that, so that you have quite a bit of power that you may not be exercising on how much and when you're going to pay your tax liabilities. Here's a very quick example, and staff, if you'll put the slide up for me. Well, the real federal tax bill, please stand up on $75,000 of gross income for a single taxpayer. Now, if you look on the left-hand column, you're going to see 75,000 gross in each one of the examples. But look at the taxable portion. It ranges from $15,000 to $63,000. Now look at the tax column. It ranges from $1,831 to $11,002. So the net amount that we have to spend, from a low of $63,998 to a high of $73,164. And the income portion that is taken away can be substantial. So you tell me, if you had to guess, which one of these particular tax bills is accurate? Is it 1831? Is it 3766? Is it 11,002? Pick an answer. Now, we're going to go through and see what this looks like. Now, you can see in this particular example, I'm going to use a retiree. So we have $20,000 coming in of Social Security. And remember, I mentioned to you earlier that if, as a single person, if they have over $25,000 a year in other income, up to 85% of the Social Security is taxable. They have a $23,000 pension. They get $7,000 that is taxable income off of a rental property. And they're taking $25,000 out of their IRA. So they have a $75,000 gross income. Now, if you guessed that the correct tax amount was $11,002, you're absolutely right if the taxable income is arranged this way. Now, what happens in example number 2? We still have the $20,000 of Social Security income. We still have the $23,000 of pension income, and we still have the rental property that generates $7,000 in profit for it each year that shows up on the return. But look at that. We took $25,000 out of a Roth IRA or non-qualified for that $25,000. So our gross income is still $75,000. But look what happened to the tax bill. It dropped down to $3,766. So if you pick that one as the answer, you are also correct. Now let's look at example number 3. Remember that $20,000 Social Security? It's still here. And the $23,000 pension. We really can't do anything about the fact that those two sources of income are taxable income. They sold the rental property and they ended up putting some of that into the life insurance, and they have a personal pension plan that they are doing and pulling off $7,000 of loans or tax-free proceeds. And they're taking $25,000 out of the Roth. Now they still have $75,000 of income, but look at that tax bill. It's only $1,831. So once again, if you chose this number, you're absolutely right, depending upon how you structure the numbers on the page. So I hope this is helping you to see where the way you title your assets and how you structure your income streams has a dramatic effect on how much of your own money you get to keep that you're not giving away to taxation. And I'd like to go ahead and conclude here with a quote from Mark Twain. I think it is empowering, if you'd like. I even had it painted on a bathroom wall for many, many years before I moved to the Caribbean. So it's very near and dear to my heart. 20 years from now, you will be more disappointed by the things that you didn't do than by the ones you did do. So throw off the bow lines, sail away from the safe harbor, catch the trade winds in your sail, explore, dream, and discover. Well, I hope this has been a benefit to you. And by all means, we'd love to see your comments. And if you want to click that like button, and do not forget to hit the subscribe button. We're adding content on a regular basis, so I'm trying to give you an education and to help you grow wealth and to retain the wealth that you have. So again, click on that subscribe button. I look forward to seeing you again. I'm Amy Rose Herrick, and I'm America's Profit Building Specialist.